Thank you very much for coming to my TED Talk. Very happy to be here. So just give me like a baseline. I wasn't here for some of the previous sessions. I know the crew who runs this. I imagine they were pretty good. So raise your hands if you think the sessions have been really, really good so far today. Shit. Okay, so another quick raise of hands. Do your clients care about performance, investment performance? Do you ever have conversations? Just raise your hands if you ever have to. Okay, cool. So this might be relevant to you. I'm going to give you a quick backgrounder into me, into how I got here today. Hit college and kind of liked economics and liked psychology and could just never choose. So I ended up doing basically psychology and economics. Did it and got a master's degree in it. And got very lucky in that Barclays Wealth, which was a high net worth asset management firm in the UK, was hiring. And they wanted to figure out if nerds could do something useful in that setting. So I joined. And we had a really good time for about 7 years, learning about how investments worked, how we could tailor, especially for high net worth individuals, the propositions, the services that we were offering to them. And I kept coming back to the same issue, which is like the advisors were great. We could build out some technology, but there was this issue that kept coming back again and again. And that's going to kind of be the theme of the talk. But I'm going to kick off with something to just dive right into it. I'm not going to solve suffering. I'm not going to solve, I'm not going to solve pain. This is from a quote from a book by Haruki Murakami called What I Talk About When I Talk About Running, which is a great book, especially if you're a runner. I highly recommend it. And I went to go and pull this out because I think this is actually something that we need to come to grips with our clients. There will never not be pain when it comes to investing. You will never have an investment that doesn't go down in some fashion, that isn't disappointing in some fashion, that they don't wish did better in some fashion. But pain isn't really that bad. It's the suffering that comes with the pain. It's the angst. It's the emotion, the thing that kind of keeps you up at night and comes out and eats up the rest of the minutes in your day. I have, or I like to think that I have, about 500,000 clients through Betterment in various forms, 401ks, through advisors directly. And they give me feedback about things. Good Lord, do they give me feedback about things? And I read it. The robot has feelings. The robot listens to you, and it cares about what's going on there. And one of the things that happens when you interact directly with 500,000 investors of various levels of sophistication and desire is that you pick up on this sort of chasm that exists between most people and most of the people in this room. There's a gap there. This thing is not, it's not a gap, it's a chasm. It's huge, right? You have these conversations with them and you realize that you're just on different planets. You have such a distance or perspective from years that just, you think about it differently. So you can kick off, a client comes in, they're like, what are your expected returns? And they want some number that's 10%. And you're like, stocks, 10%, past 100 years or something like that. And what you really mean is I don't know, man. Anywhere from here to here over a 1-year time period and then compound that out 30 years. It keeps coming up, right? It's how long are you thinking for? How often are we going to really assess the performance of this thing? What are we comparing it to? What's the benchmark? And it just goes on. There's some serious stuff, which is they're I keep looking at Yahoo Finance. What's going on with my investments? And you're you bought a bond fund. What are you talking about? So this gap, it's not one thing. It is years of experience and technical knowledge that is accumulated inside your heads, and it's literally called the curse of knowledge. It is very hard to remember what it is like to be that normal being again, that normal human who hasn't had years' worth of experience. And part of what we do as advisors is to do this sort of personal coaching thing, where you try and change them. It is your job to have conversations with them, to talk to them, to literally change the way that they perceive the world inside of their heads. There are some really good tools and coaching for coaches sessions for this. I think there's one called Kinder. I imagine there are a lot that are offered out there. I didn't see it, but I imagine Dan Crosby's tool in the other room might have been very useful. I'm not here to talk about that. That's not my book. I'm here to talk my book because I know my book, because I created my book with my own thoughts about how to do this. And the critical thing here is that I am not going to try to change the investor. That's not what I'm trying to do here. I was looking at all of the technology that investors were using. And it was very clearly that like the thing that they were using to help their clients was undermining the very thing they were trying to achieve. So how does that work? What does that look like? I'm sorry, I got to do this. It's part of like what you get when you get a master's degree is that you have to put a brain on one slide of every presentation. The cool thing here that I love, so the neocortex, the sort of human thing, right? This is like bringing a nuclear bomb to quite literally a tooth and claw fight. This thing is so massively out of proportion in its abilities to a lot of other evolutionary things. But it's new. It is brand new. You can do this fun thing where you start going backwards down the evolutionary chain, right? Strip away the neocortex. What do you have? You have this part of the brain that's mostly associated with mammalian brains, memory, emotion, right? Keep going. Go even further down. What do you get? You get a reptilian brain. Is your heart beating? Are you breathing? Are you hungry? Do you need to move? Here's the rough thing. The monkey only gets to have a say. We only get to have a say when the reptile is happy, right? It's like higher floors on a building. If the foundation's not happy, we're not going up there. So you get this thing where a lot of what our, how do I put it, our like highest pinnacle is can get undermined by being hungry or sleepy, other things. There are other ways that our lower brains betray us too. And that's why when a client's in a market downturn, this isn't what they need. It's just like literally, they're not open to it. They need something emotive, something that makes them feel better. I don't know that like promises or guarantees are going to do it. Hugs very well might. There are other sort of things that pop up again and again. This is one of the kind of questions that you ask, especially if you're an economist trying to get at some sort of like risk tolerance parameter, right? The numbers do not matter. Please don't worry about reading it. Don't think about like what gamble you would take or anything. I play this game sometimes where I'm an evil genius named Damien. And I play games where I'm like, if I wanted to make sure that people just lowered their risk tolerance, if I wanted them to buy more bonds in this situation, what would I do if I wanted that to be the outcome? The answer is usually pretty darn straightforward. If you just change an outcome that is bad to a bright red color, you're going to increase people's risk aversion. Like that, like 25% down, boom, just because I changed the color. That's pretty easy. And once you see this and you understand it, you just start seeing it like everywhere, right? Like, why do we saturate the platforms, the interfaces that we use to manage our money with danger colors? What kind of reaction are we looking to try to trigger out of that? I don't think anybody's going to use an investing in a mobile platform that has no color, that's dry and gray and boring. And I wouldn't want to do that either. I want to use color. I want to take that same thing, that same visceral urge that comes up when you use bright color, and I want to use it for good. I want to take that same insight and I want to say, you know what? Your future, not the past, your future's not looking so good right now. There's danger ahead. We should do something about that. And what's nice is that while I can never change the color of what my stocks did, I can change the color of my plan. I can actually allow clients to wiggle whatever those inputs are, how long they're going to save and invest for, what risk level they're taking, how much they're saving. They can actually turn that thing the right color if they want to. They are not powerless in the face of that horrible orange color. So, as I said, a lot of what I do is I don't try to change the investor. I change the context that the investor exists in, such that they are going to be more successful. So the best case of this, and my apologies if you know this already and you've heard it before, is in 401ks. So for years, 401ks were underutilized dramatically. People weren't saving enough. The downfall of pensions meant that it was going to become a really big crisis. Most people weren't using them. They weren't participating. And when they did, they weren't saving enough. And a couple of people like me came in and said, like, oh, easy, we got this. We understand exactly what's going on here. And they implemented a few very specific changes. And it took it from 2 in 10 to 9 in 10 participating. And after 4 years, part of what was built in was an automatic escalation over the years. They were saving 14% of their gross pay, at which point in time, they said, we have to turn this experiment off. We're actually worried that people are going to be saving too much, which is pretty remarkable. So what did they do? They just took the same problem of 401ks and they looked at it from a different perspective. They said, okay, well, are people saving by default? No, they have to fill out a form. And I don't know anybody who enjoys filling out forms. What's the savings rate? Well, you got to figure that out. That's up to you, okay? Usually you start this after you've started your job and received 1 or 2 paychecks, which means that all of a sudden your paycheck goes down, which doesn't generally feel very good. And it's up to you if you want to like increase the deferral rate if you get a future raise. They just looked at all these and said, could we literally like turn the light switch the other way on these? And the answer is yes, you can. You can just say you're saving by default. When you do, you're going to be saving 3% or more. We're going to auto-escalate it. They didn't try to change the person. I'm going to come back to this because it's nasty. They didn't try to change the person. They just changed the context. They would say, this is a person. This is how people act. We're going to change the context that they're making decisions in. A big part, the hardest part in some ways, of knowing a little bit more is that I believe, a lot of us live more in the future than the people we try to help. We're thinking a lot more about what we are doing today in order to get us to some point in the future. We have a better intuition about the fact that that path will not be straight. There will be ups, there will be downs, there will be setbacks. We will change it. What we put into a plan and a piece of paper today is not exactly what will happen, but we want to build in some margin of error, and we want to know that we're going to hit some goal that's important to us in the future. Here's where it gets weird. Usually, most of us, at least in my experience, from a client's point of view, are going to have something that looks like this. They have that planning conversation once a year, maybe a couple of like checkups, maybe a mid-year checkup. And in between, they're going to get quarterly performance reports. Heck, they might get monthly performance reports or daily performance reports or intraday performance reports about what's going on. Is that what we want to be having a conversation with them about? Is what's happened over the course of a day or a week? Or is it the path to the goal? Why is it set up in such a way where most of what we are showing them, most of the sort of screen surface area and time surface area, is dedicated to things showing best performing and worst performing funds over the past 3 months? Does anybody in here think that that's like the best way to have an ongoing conversation with a client about their financial plans? You can raise your hand, I won't judge you. Okay, interesting. So why do we do that? And what does it do? There's a pretty straightforward way of understanding happiness, right? Did you exceed your expectations? Did reality exceed expectations? Some of us are engaged in the act of trying to change future reality. That is good and important. Ensuring that you can achieve the outcomes that your clients want is very good and important. Changing reality is a very important thing. You can also change the other part of the equation. You can change the expectations. You can change the way people think about the outcome in between. So, who here has ever had the experience of like, you sign up a new client, I don't know, they're sort of like 6 months in, and they're like, hey, I was checking my account and I'm down like 6% since I started with you. Is that right? Is that the way that it should be? Do we need to have a talk about this? It happens a lot. We run the numbers inside of Betterment's retail base, and you start seeing people attrite at a higher rate as soon as they see a 1% loss. People come in, apparently expecting to invest in a 90% stock portfolio for the next 10, 15, 20 years, and they see a 1% loss, and they get worried. Part of what happens is that usually when you start investing, you're going to context the space with that return. You start out, you have 0 return, then you have 1 day's return, then 5 days returns, et cetera, et cetera, et cetera. If you only have the blue line to go on, all you know is that you've had like a 6% loss, right? I started investing with you and this happened. The context in what happened is like, things went really well. Do you guys remember 2017? Damn, that was a good year. It was weird, it was so good. There was no volatility. It freaked me out. I hate those years. Being able to say, this is the little experience that you have. Let's put it in the broader context of how we invest and why we invest this way, so that you can see that you just started a journey. Somebody else started this journey 3 years ago, and you wish you were them. But years from now, you're going to be them, and somebody else is going to be starting this journey. One of the things that I came in with a wrong impression of was that we needed to simplify how we talk to people about returns and investing. When they're looking at the technology, when they're looking at their performance reports, you actually have almost an opposite reaction. People actually treat computers and algorithms very differently than they treat human beings. And one of the things we learned is that rather than giving them small, bite-sized little nuggets of information, this is specifically about performance, about our performance page, not advice or guidance in any way. We were frustrating them. They wanted to see stuff. They wanted to know stuff. They wanted it all in one place. And we said, OK, cool. We're going to literally throw the kitchen sink at you. We are going to start putting up so many metrics directly in front of you. We're going to overlay all of the different lines for the different goals and how long you've been investing for them. We're going to show your inflows and outflows and fees, all this stuff. And literally, the designer who I work with on this, he was like, this is never going to work. This is so horrible. I'm like, well, let's try it. What might happen? What we learned is that this stops them cold. And they say, I need to think about this. This is serious and important. There's everything here that I need to know if I pay the time and attention to really try and understand it. All of this information is about, to some degree, like what the market did, returns, different risk levels, blah, 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 when they put money in, when they took money out. You'd be surprised how many clients are confused why they don't have as much money as they put in. They forget that they take money out sometimes. It makes them very sad. There's another component to it, though, which is reminding them that they are not sort of like passive passengers on this. They do stuff. They put money in, they take money out. That influences their their money-weighted returns. They change the allocations. That changes their time-weighted returns and their money-weighted returns. We do stuff. We automatically tax loss harvest for them. I'm going to come back to tax loss harvesting because it's one of my favorite examples. Showing what you do, showing the value of it on the page, that's our performance. What does Betterment do for you? Well, we manage some portfolios. We try and keep you on track for your goals. Are we doing the things that we said we would? Do you see them? I'm always surprised. People will literally write in and be like, I'm so happy, I just had a tax loss harvest. I get it. It's cool. It's weird. Another component is that human beings, especially in their thoughts, they were very bad at thinking about things outside of context, right? Is 7 good? Is that a good number? You guys think? Right? I don't know. I mean, could I get like 99? Showing people the context, the frame of reference, is something that we don't do enough. Oftentimes, we'll use a benchmark or something. In this case, what this actually is the performance of Betterment's managed portfolios compared to target date funds that have an equal retirement date of the client who we are managing them for. And the only purpose of this is to say, like, yeah, we're pretty much dead center of the pack. We're not trying to beat the pack. We're not underperforming the pack. We're just in the center of the pack. Rather than have clients compare you to one external reference point, like a benchmark or something, give them the context of the peers, the alternatives that they might actually consider. Very few clients can actually invest in an index, but you can invest in a good fund that might outperform or at least be in the middle of the pack of its peers. Another component that really matters is the expectations and the understanding that they come in with, right? And I think it's very important to set very clear expectations about what you will do and won't do at the outset. There is nothing worse than a client who believed you were going to do something, and you didn't. And then at that point in time, you're telling them, oh, I'm sorry, I don't do that. At the outset, they should be very clear about what you do. A lot of times, we had clients coming in saying, like, oh, I thought you guys used sophisticated AI strategies in order to time the market with option strategies. We're like, good God, where did you get that from? Like, that's not anywhere on any of our stuff. It is better, it would be much better if clients come in and we have kind of like, a constitution, an agreement about like what we are going to do and what we aren't going to do. I'm not saying you need to use this one in any way. This is specific to your firm, what you do. But just make sure that if you ask your client, what is it that we do during a market downturn or when things get rough, they're not like, oh, well, like you obviously go to cash and start buying leaps, clearly. The last part, which is kind of cool, and this is part of why I moved to Betterment, is because I'm able to do sort of funny little things, is putting very small little ramps and informational buckets in that we can learn from based on our clients' actual behavior. So a while ago, we realized that based upon the way people were thinking about us, they would come in and they thought the only possibility they have was to have kind of like a stock portfolio or to take their money out and put it in cash. They thought there was no kind of like in-between in those things. So we actually put together a flow that if they came in and they were like, hey, I'm just going to withdraw everything, this pops up. To be clear, if you're on the Betterment for Advisors platform, it actually pops up and it says, you should probably call your advisor. Here's their phone number right at this point in time. Please do that before you do this. What we found is that when we actually give people alternatives like, oh, you could put it in a savings or cash reserve account here, or you could put it down to like 30% stocks, they would do it. You just needed to give them an easy, like 1 or 2 click off-ramp that made them feel more comfortable. Sometimes it's not just their behavior you need to actually understand, it's their motivations. It's like whatever's inside their head that's driving it. And we do this a little bit. After a client goes ahead with an allocation change or a withdrawal, or even an ad hoc deposit, if you read kind of like any pop retail book about investing, at some point they're going to say, you should have a decision journal where you write down what you were thinking at the point in time when you made that decision. And we actually do that. We do it, we say like, what's the general category, add in the specific details, write out a little text note, and then when you go back, if you look in your activity or you look at an allocation change notice, it says why you did that. In this case, large credit card bill. These are both like wonderful and horrifying to read. Because you get like, truck broke down, needed to fix axle, glad I had this money. New baby was born, buying clothes, smiley face. Wonderful, wonderful things. You get the most common reason people withdraw is because they're putting a down payment on a house. Fantastic. Then you see things like, I believe that the Treasury and the Fed are going to do this over the next 2 years, and then there's going to be inversion with some contango, and I really think that Trump's doing X, but it was probably the Clintons, so I'm going to move to cash now. If this note goes beyond like 2 or 3 lines, you know you're in for it. There's this just like a story there that's amazing. Okay, so this is the vicious part about my job. Really, really vicious part about my job. Who was the guy, this is a brief tangent, who was the guy who worked as Trump's like comms person for only 17 days? Cool, okay. Who built this? I'm looking for a person, not like an entire civilization. Caesar. That's a manager. Sometimes we pay attention to the wrong things, right? Some Roman came up with the idea of these arches and then layering them on top of each other. These things are scattered all over Europe. They have existed and stood, and they are still used hundreds of years later, and we have no idea who built them. This is not short-termism. This is building a fundamental, strong foundation that lasts time and does incredible things. It is not flashy. We don't know who did it. They don't get in the press much. That is amazing. And that's a large part of what my job's like. You do good things. You run split tests. You run randomized controlled trials where you say, we changed the design in this way, and people reduced their allocation changes. They saved more. They were able to avoid taxes in one way or the other. But no client is ever in both arms of a split test. They never know what the counterfactual was, what might have been if they hadn't used that. Good design can be beautiful, can make you feel very happy, but it's very hard to know when it's been successful, when it's laid the foundation for really, really good long-term success. So unfortunately, I don't get many raises. So last part, bringing it back to actually the pain thing. You guys know that feeling after you do a really good workout? You're like, I'm gonna hurt tomorrow. I can feel it coming, and then tomorrow it hurts, and it's painful. In a large amount of things in our lives, for better or for worse, pain is a feeling and a symptom of progress. It is muscles stitching themselves back together again. It is the discomfort that comes with trying to learn a new skill, playing an instrument. It sure as hell is painful to be a new parent, not getting enough sleep, being cranky all the time. I can't do it. I can't use design to make people think that pain is progress. There are little things you can do, like saying, hey, your portfolio went down and we harvested a loss, so you're going to have a lower tax bill. We can do that. That's effective. But that fundamental idea of saying that pain is actually a symptom of progress that we should be happy for, that we should look for, if you are not a little bit sore, If you don't need a little bit of rest, if you're not a little bit uncomfortable, then you're not pushing yourself hard enough. The strenuous life is a good life. You are sitting around and you are never sore, and you're never in a little bit of pain. You're probably not pushing yourself hard enough. So with that, if you're crazy, like me, and you think that pain might be a virtue, I got about 20 people, and we're going to go up Camelback tomorrow starting at 6 a.m. You're welcome to join us if you want. There'll be some pain. Thank you. They said I was allowed to take questions if I wanted to. I've got 4 minutes. It better be a good question. No, we're good. All right, I'm out. Thank you.